The situation in our economy right now will be going down in the history books. With inflation reaching levels we haven't seen in 40 years, gas prices soaring through the roof, stocks in a bear market, and the Fed increasing rates by 75 basis points, the biggest since 1994, how close are we to a true recession? And if one comes, how do we best prepare for it? Well, before you panic, in this video, we'll be going over all that and more to make sure you're able to continue building wealth no matter the scenario. So traditionally, recessions are when there's 2 consecutive quarters of negative GDP growth, although the official definition is dependent on a committee from the National Bureau of Economic Research. But going with the traditional definition, we're already halfway there because in Q1 of 2022, we had a decline of 1.5% in GDP, with the next report being at the end of June. However, with the Fed recently hiking rates by 75 basis points, we could see poor numbers again in June, especially when there was a surprise re-acceleration of inflation which caused the Fed to do a 75 basis point hike instead of a 50. And that's because there's a relation between inflation, interest rate, and GDP. Back in 2020, when everything slowed down, supply chains were affected, factories had to cut or slow production, and our whole economy also slowed down. So in order to counteract that, the government injected a ton of money into everyone's pockets in order to promote spending and prop up the economy. In fact, 40% of all US dollars were printed back in 2020. Not only that, but the Fed also cut rates down to 0, which meant it was much easier to borrow with low interest rates, which discourages saving money and encourages spending money instead. For example, if you could borrow money at 1% and know that you can get a 5% return elsewhere, then that's a no-brainer. But all that spending is starting to backfire. With things opening back up, all that pent-up demand from people wanting to spend is being unleashed in a world where supply chains haven't come back to normal yet, and there's all these other events happening in the world, which means basic economics. Higher demand and lower supply drives up prices overall, causing inflation. Heck, even McDonald's Big Mac prices have gone up 40%. So how does the Fed counter that and prevent a situation like Venezuela from happening? Basically the opposite of the last couple of years, so raising interest rates. When the Fed increases rates, it makes it much harder for banks, companies, and everyone to borrow money, which will in turn encourage saving and discourage spending money. Using the same example as before, if it costs you 5% to borrow and you only still get 5% elsewhere, then you probably won't go for that. And all this slowing down the economy leads to GDP stagnating as well. With less demand and the same supply or even increasing supply from all the expectations that companies may have had. Like how Target and other major retailers are putting on big discounts to clear the inventory. Basically, this type of environment is unlikely to change for the positive in the next few quarters or even next few years. There's a lot going on with the Fed, the government, inflation, GDP, and more. But this all does trickle down and affects you and I as well. We've already talked about how everything's been getting more expensive, including Big Macs. But you can also see effects if you've been eyeing the real estate market too, since mortgage rates have been increasing fast, going from rates in the 2s to over double in the 6s, as well as seeing stocks being down 20, 30, or some over 50% down from all-time highs, index funds included. These few years will be history in the making, but also probably one of the best opportunities to make life-changing wealth as we eventually come out from this slump. Bull markets make you money, but bear markets make you rich. So let's go over how to capitalize on these rare few years to not only survive, but come out even stronger. First, you gotta make sure you have a solid foundation with a good amount of savings. As sad as it is to say, a recession will come with layoffs, which have already started happening across the tech industry. And even without layoffs, people may have their hours cut, leading to less income that they may desperately need. And so with any financial plan, you'll want to make sure you have enough to keep you afloat during those hard times, usually anywhere from 3 to 6 months of emergency fund. But to be on the safe side, you can consider having more than 6 months in this fund instead. And with 60% of millennials not having enough to cover a $1,000 emergency, just by having an emergency fund like this will put you much more ahead of the rest. Back in 2020, people had stimulus checks to help support them, but with the Fed reducing their balance sheet through quantitative tightening and trying to drain money supply from the markets, this is unlikely to happen again. So to make sure you can cover any surprise expenses or buy enough time before you get another job or another source of income, you'll want a safety cushion that can support you during that period. Next, you'll want to get rid of any high interest debt you may have, especially ones like credit cards that could be charging you 20+% in APR. Though in general, I'd say anything higher than about 5% can be considered high interest debt. Paying off debt in general is like getting a guaranteed post-tax return on your money, something you don't find easily. For example, paying off your credit card debt in full could save you that 20% you would have had to pay in a year. And in uncertain times like this, when everyone is going risk off, your high interest debt could fluctuate and get even worse over time. You could get laid off or have your income cut, which makes it harder to repay your loan, leading to late fees and interest charges that will only snowball the amount of debt you owe in an already bad environment. From there, your credit score may suffer, and when things eventually do get better and you want to, say, borrow money to buy a place, you won't be able to get the best rates. Not to mention the stress you'll feel when all of this plays out. So you built up your savings and paid off all your high interest debt. Next, you want to make sure that you're living within your means. Yes, that means not going off and buying a Lambo when you're only making $50,000 a year. In general, as you make more money, you want to avoid lifestyle creep, where your expenses go up at the same rate as your income does, so you never have more money to save and invest. Because if you end up losing your job or get negatively affected by the recession, it'll be hard to keep up and support that lavish lifestyle. These are the times where you might want to consider going risk off, which means not taking your job for granted or taking that risky jump to a new industry or a company. You may also want to consider additional income sources like side businesses, so when one income stream dries up, the other ones can try and take its place. Especially in an environment like this, maybe eat out less so you're saving money there, or put off that new car you've been eyeing in order to beef up your savings, or to continue dollar cost averaging into the markets, which is exactly point number 4, where despite how things look, you should continue to invest. Bear markets will humble investors, especially ones that have only started investing in the last few years, where everything has been going up and to the right in a straight line. But all good things come to an end, and we're entering into a much needed cooling off phase before we can start the next rally. So doesn't that mean we should sell everything now and wait for things to rebound before investing? Well, no. Although many have tried, no one can predict the bottom. Well, maybe those who are predicting a bottom every single year, because a broken clock is still right twice a day. And because we can't predict the bottom, the best strategies is still to dollar cost average into good broad index funds like VT Sachs, because Bank of America found that if you miss just the top 10 trading days every decade since 1930, you'll only have a return of 28%. Whereas if you stuck in the market, you'd have almost 18,000% return. Another way to invest is through solid companies with great fundamentals, a good balance sheet, and sometimes even growth in an environment like today. For example, companies like Google, Amazon, and Apple, who all have strong fundamentals that will likely carry them through a recession and come out even stronger. A lot of people are scared by the red they see in the markets from day to day, but stock prices going down in a market like this doesn't really affect the company's fundamentals for the long term. A big reason for the markets today is psychological, because people are selling out of fear, which will then put additional selling pressure on the markets. Instead, think of these prices as sales for the same great companies you would have been buying just a few years ago. I mean, if you go to the grocery store and you see your favorite chips go on sale, you probably want to buy it more, not less, and the same goes for the stock market. Then once things go back to normal and stock prices return to their usual levels and trajectory, you would have already profited a ton from buying when it was lower. This is exactly why people say bull markets make you money, but bear markets make you rich. as well as be greedy when others are fearful. These are the times where you can make a life-changing long-term wealth by continuing to dollar cost average into the market, knowing that no one can predict the bottom and that things will eventually get better, which has been shown over the 10 worst trading years in the US stock market, where in the following 3 years, all were positive except for one, with all instances being positive 5 years after. Which brings me to point number 5, which is to invest in yourself. With most people, investing in index funds is the way to go. But if you want to find solid companies to invest in, then you'll need to put in the research and figure out how to, say, read a company's balance sheet. And what better way to increase your knowledge and learn about those things in a slow or downwards market like this one. You'll also want to consider adding new income streams, say by starting new side businesses, or keeping yourself fit and healthy by maintaining a good lifestyle. Basically, you want to set up good habits that will accelerate your growth and set you up for success coming out of a potential recession. Invest in yourself, stay disciplined, and focus on the long term instead of any short-term FOMO style plays. Time in the market is better than timing the market, but even outside of a recession, all the tactics in this video still apply for building long-term wealth. Now, earlier we talked about how having credit card debt is one of the worst debts to have, but there are lots of ways to benefit from and earn thousands of dollars from credit cards without paying any interest charges or late fees. So check out this video where I go through all the cards I have in my wallet and why they're all worth it. Thanks for watching, and I'll see you over there.